Hello, everyone. Today we had the UniCredit Investment Committee, where we discussed the 2025 macroeconomic outlook and investment strategy. And I am here with Marco Valli, our chief economist. My name is Manuela D'Onofrio, and I head up the investment team. And we will discuss about all the topics, very interesting topics that will guide our investment strategy for next year. Let me just make a remark on how important this time are the measures that the new administration in the United States will deliver during the, let's say, first half of 25. In fact, we think that the conditions are pretty favorable for the new Trump administration to deliver a big portion of the plan he presented during the electoral campaign. And this, if it happens, will have for sure a very important impact on the US economy and therefore also on the European economy. So let me ask Marco. Marco, what do you think are the macroeconomic variables that could be mostly impacted by the decision that the new administration is, let's say, likely to take in the next few months?
Yes. First of all, what can we expect? I think Trump is going to implement significantly more expansionary fiscal policy. It's already very expansionary. He will add to that. He will probably implement also tariffs. We do not know exactly whether he will fulfill all the commitments that he made during the electoral campaign, but it's plausible that he will hike tariffs, okay? He might use them initially as a sort of a bargaining tool, but ultimately higher tariffs, I think, will come. And then I think he will also implement tighter rules for immigration, which has the impact of reducing labor supply and potentially generating mismatch between demand and supply of labor. What is the effect of the combination of these factors? If we also add a dose of deregulation, which will almost certainly come. I think it's very likely that fiscal policy will keep GDP growth above trend, above potential, both in 25 and in 26. And all the three measures, tariffs, fiscal policy, and tighter immigration, would probably leave inflation above 2%. So will prevent the slowdown in inflation, which we're previously expecting before the election. This has a very clear implication for the Federal Reserve. While before the election, we thought that by the end of 2025, the Fed fund rate would drop all the way to 3.25%. Now we think that the Fed will have far less scope to its monetary policy, and we are looking for a terminal rate of 4%, after which the Fed will probably enter a wait-and-see period to try to understand if, what, and to what extent Trump will implement his agenda.
So, Marco, if I can summarize it, what you're saying is that the fiscal policy in the United States will still be pro-growth. Therefore, there will be probably less need for the Federal Reserve to cut rates. What about Europe?
In Europe, the picture is quite different. Tariffs will be quite negative for the growth outlook here in Europe because Europe has a large manufacturing sector and the US is our main export market, right? So higher tariffs means less trade to the US, means more uncertainty. Typically, more uncertainty implies less capex and potentially more downside risks to the labor market, right? In terms of inflation, yes, we have seen a bit of weakening of the exchange rate, euro-dollar, not dramatic. If there is some retaliatory measures by Europe vis-à-vis the US, this will also potentially lift inflation, but only, I think, in the short term. To me, the prevailing force, when you look at inflation at the medium term, is through the negative growth impact, and potentially this could imply that over the medium term, there is going to be less inflation than in a pre-election environment. And this has very clear implication also for monetary policy in Europe, because while before the US election, we thought that the ECB would stop the rate cuts at 2%. Now I think that there is a higher likelihood that the ECB will have to cut even below 2%, probably already by the end of 2025.
Let me ask you a difficult question, okay, and it's about China. The relationship between the United States and China has been, I would say, quite difficult since the first Trump mandate. What do you expect it to develop? And what is, let's say, the forecast for Chinese economy, if you already have an idea what could happen in 25?
I think China will remain under pressure. Trump will almost certainly increase tariffs and will impose further restrictions when it comes to high-tech products. This, in our forecast, will expose the domestic weakness of the Chinese economy, because currently what we see in China is the ongoing correction in real estate, and we think there is still some way to go. What we see is that household confidence is very low. A lot of households are invested in real estate, and the unemployment rate has been rising. So there is not a lot to make households confident at this stage. And in the new world, I think this is not going to improve anytime soon. Then I see big structural headwinds for China. Poor demographics. We have this ongoing de-risking from China by a large number of European and Western firms. And in general, obviously, there is, from our perspective, a problematic approach to fiscal policy in Beijing, because there is too much emphasis on fueling investment and too little emphasis of supporting private consumption, on reducing the very high saving ratio of households in China. How would you do that? Potentially through structural reforms. For example, adopting a sort of Western-style safety net and welfare state, which is currently not going to be in the agenda of the Beijing government. So that's why I remain cautious on China. I think that the structural slowdown in growth will continue. Growth rates approaching 4% in 25 and 26. So the slowdown, I think, will continue.
So how do we translate these views into asset allocation decision? So we heard from Marco that basically of these three regions, of these important engines of world growth, there is only one that with a very highly likelihood would run at a fast rate, and this is the US. Therefore, our decision to prefer US equity, especially vis-a-vis European equities, where we want to be cautious at least in the first part of 2025. On China, we have been cautious, I would say, now for more than a year, and we continue to be extremely cautious in general on emerging markets equity. As far as equity are concerned, we think that 25 is going to be the year of, I would say, bottom-up investing, meaning that a very important selective attitude has to be taken vis-a-vis the US equity and also the European equity. I would say, the three central banks that basically we've mentioned, United States Federal Reserve, European Central Bank, and the Central Bank of China, I would say that the one that has more, I would say, urgency to cut rate is the European Central Bank, because we are entering into probably the third year of very weak growth, especially in Germany. Therefore, we expect more cuts, which is going to support the European bond market, where we continue to be positive, especially on quality bonds. One final question, and it's about the US dollar rate, that people always want to know what we think about it. And very shortly, Marco, your take on that.
Yes, let's look at the fundamental drivers, the growth performance. The US growing above trend, Eurozone growth probably below 1% next year. Interest rate differentials, the Fed is stopping at a higher level than previously expected, probably 4%. The ECB maybe even going below 2%. So the interest rate differential is going to widen. This means that there is further downward pressure in our forecast on euro-dollar, although not dramatic. We think that a large part of the move has already happened. We think that we will be approaching parity, not quite going to parity, just above parity, and basically staying there for the next several quarters.
Thank you very much, Marco. And let me say just one more thing, that all the topics that we discussed very briefly, you will find them on the UniCredit 2025 Outlook, which will be available shortly in the next few days on our UniCredit International website. Let me also take the opportunity, although it's pretty early, to wish you all a very nice holidays period. Talk to you very soon.